Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including hedging through precious metals, wealth advising, a unique short fund, and an excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to take advantage of the free portfolio risk analysis and bank safety ratings they're offering our listeners. Just call them at 1-800-525-9556, and you will be put in touch with an advisor with years of experience who can take 15 minutes and give you a much better understanding of what true portfolio diversification is. Again, call them at 1-800-525-9556 and benefit from their expertise. Hi everyone, this is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 30 years of experience working in the financial industry and over 20 years successfully shorting stocks. He's hedge fund manager at Baring Asset Management with his partner Bill Lagner, and he's a follower of the Austrian School of Economics. Kevin Duffy, thank you for joining me again.
Thanks, Jason. Thanks for having me. And is this your birthday today?
No, it's not my birthday today.
No?
I think you haven't been on Skype in a while. My birthday's in October.
Okay. All right.
Yeah, I mean, my birthday after age 30 is kind of all downhill. So.
Yeah, believe me, I know what that's like.
Okay, well, I want to ask you about your presentation you gave at Jim Grant's Interest Rate Observer Conference in March a couple weeks ago. You sent me your slides over there, and I didn't get to attend the conference, but I want to hear more about your presentation, and you're nice enough to come on and talk about it. And you entitled your presentation, Mr. Market Flunks the Marshmallow Test. So for our listeners who aren't familiar, what is the marshmallow test?
Okay. Well, the idea, first of all, with the group that we had, very high investment IQ, and Jim Grant asked me to make the bear case. So I wanted to make sort of the surface level bear case, but then get into the what's below the surface, the economic foundation. And I started thinking about, well, what are the necessary ingredients for economic growth, economic prosperity, and you think about sound money and free markets and expanding trade, expanding division of labor, and but I thought the really basic ingredient is you need deferred gratification, delayed gratification. So the idea that that people will set aside savings and produce and able to consume more later, invest that in projects with that lead to greater production. So the test, the marshmallow test, was actually conducted by a Stanford professor back in the late 1960s. And what the tester would do is they had 4 or 5-year-old children, and they would put a treat like a cookie or a marshmallow in front of them. And if they could resist that eating that marshmallow, the tester would leave for about 15 minutes and then come back. And if they could resist, then they got a second marshmallow. Well, as it turned out, of course, 4 and 5-year-old children have a very high time preference. So they 2/3 of them just couldn't resist the temptation. And then what the researchers did was they tracked these kids into adulthood, and they found that it was actually statistically a very good predictor of future success. Things like educational attainment and SAT scores, and even weight-related issues.
That's very interesting. Yeah, I've seen that before, and they've kind of shown these things in movies sometimes. Like what there was the old saying about a bird in the hand is better than 2 in the bush. I've heard that one before, but if you're going to build a business or become successful long term, you need to have delayed gratification. You need, in order to be a capitalist, you need to have capital.
Exactly. And the idea was that I wanted to weave this into policies that really promote fiscal and monetary stimulus, especially monetary stimulus. And the idea is that they're promoting consumption first, and that that this basically can't work. Goes to the root of the Austrian theory of the business cycle, that if you normally interest rates will regulate this trade-off between having it now, having a high time preference, and being able to delay gratification and having more later. But if you alter the interest rate, then some really bad things start to happen. You send conflicting signals to the consumer to continue to consume at the current rate, and to the producer to keep on consuming. And the problem is that the producer is making his plans based on resources being set aside. Well, if the consumer is consuming those resources, then at some point the resources aren't there to complete the projects, and that's what leads to the bust. So the basic idea is that this is not the boom bust cycle is not a function of the free market. It's a function of intervention. It's a function of credit expansion, of fiat money, of fractional reserves, central banking.
Yeah, and the other thing about consumerism is even without interest rate manipulation, Keynes believed that consumerism would drive the economy. But if you don't have savings, if you're consuming more than you can produce, maybe in the short term you can do it for a little bit by credit card, maxing out your credit cards or something. But then long term, you're going to really get screwed over because of this. So there's huge consequences. Keynes would say in the long run, we're all dead. But, if everyone's drastically over consuming and up to their eyeballs in debt, society's in big trouble. So this is, I don't think Keynes ever really disproved Say's law, which is that you have to produce before you can consume, that you have to create supply before you can consume. So, unfortunately, people are like, oh, Keynes's ideas are not real. The Keynesian economics that we have now is not what Keynes really wanted. Well, a lot of it is, I would say, is what Keynes wanted. And, he's being proven wrong. We've had about 100 years of Keynesian-related ideology built into our economy. This is why, we have the Michigan Consumer Confidence Index, that people without jobs are still confident in spending. The other thing in your presentation, Kevin, you talked about pulling, with the manipulated interest rates, the valuations on asset prices forward. Do you think this is one of the four most overvalued stock markets of all time? Is the current stock market valuations up there with 1929, 1999, and 2007?
Yeah, and I think each of these bubbles, if we go back over the last three bubbles. So we had the tech bubble in 2000, we had the housing bubble, which was really 2005, and then that kind of morphed into the credit bubble, which peaked in 2007, and then we have this. I'm going to call it a stimulus bubble, stimulus and sovereign debt bubble, but it's really a stimulus bubble. And I think each of these is different in terms of valuations. What's interesting about the tech bubble is that if you looked at something like price to sales ratio, much lower than it is today. So I think this is an important point, that each of these bubbles, they change their spots. And that's why people can get fooled over and over again. If they were the same every time, it wouldn't happen. So if you look at the tech bubble, you had really this funneling effect into the dot-coms, the technology stocks, but you also had an anti-bubble in the old economy stocks. Today, it's much more broad-based, so you see much higher valuations in terms of, let's say, the median price-to-sales ratio. If you were to look at something like the enterprise value, or the Wilshire 5000 to GDP, today it's a little bit below where it was in 2000, but 2007, the bubble was definitely below the 2000 and the 2017 bubbles. So they're all kind of different, but I'd say an apples to apples comparison, the valuations today are high, pretty much any way you measure them. But that doesn't mean, of course, that every stock is overvalued. I mean, it's a market of stocks, not a stock market.
Yeah, and it doesn't mean that things can't go higher before they crash. So, I mean, we're in irrational territory now. You've outlined before, record amounts of margin debt that have come out. The other thing is the share buybacks. I think since 2009, there's been way over $1 trillion in corporations borrowing with debt for share buybacks, and they're not using free cash flow. So that's an important distinction. There's a big difference between a corporation using free cash flow to buy back their stock if they think it's cheap, and corporate CEOs and upper management using debt to buy back stock to make earnings look higher, financially engineer earnings, trigger their stock options packages. How overvalued? Based on these share buybacks, and let's say you could actually remove the amounts of share buybacks. How much do you think they financially engineered earnings higher? Do you think earnings are 40% higher, 50% higher with all these share buybacks in?
I don't honestly know the answer to that question, Jason. What I tend to do is just a bottoms up, stock by stock, and I just see a pattern there. I see that, and I look at a lot of companies in the retail area. Target, you can look at the buybacks, and it's almost a perfect contrary indicator. It's amazing how these buybacks really dried up in 2009 and 2010. And I think this is kind of goes back to the marshmallow test. This is the great seduction, and what I tried to get across with this talk was the idea that some companies, not everybody, just like the marshmallow test, not every kid takes the bait. Some of them can hold off, can delay gratification, and it's the same way with these companies. Some of them they can't resist the temptation. And so you have, on the one hand, a company like, let's say, Amazon.com that's building this incredible juggernaut in e-commerce. And if you look in 10 years ago, they did $3.5 billion in gross profits. Now the retail side of it is doing over 10 times that amount. So here's a company that's really planning and thinking long term, just reinvesting in the business. And meanwhile, you have a lot of retailers that weren't paying enough attention to Amazon, and they're paying much more attention to sort of, let's maximize shareholder value. They're listening to Wall Street, and they're buying back their stock, and they're not really setting aside the rainy day fund. We gave an example of Aeropostale. This is a company that was, of course, they're in the teen retail business, which is a very fickle business, and it requires, it's going to go through times when they're out of fashion, basically, and this company was doing very well, and unfortunately, during the good times, they spent over a period of about 4 or 5 years, they spent all of their cash flow, all their free cash flow on buybacks. And then when, of course, things weren't going well, there was no rainy day fund, and now they're bankrupt. And now they're part of the roadkill that's going on in the mall space.
Did they overexpand too? Did they open up way too many stores and use their free cash flow for way too much growth as well, in addition to the buybacks?
Yeah, it's interesting. They did that, and I think if you look at the retailers in general, there was, I believe, from 2000 to about 2007, the peak of the credit bubble. You had retail square footage growing about 8% a year, and since then, it's slowed down a lot. Quite a bit. I mean, it's been a huge, drastic, just fall off the table. But there was still all this capacity from that period, from the credit bubble period. And instead of systems, spending the money on systems, and instead of shoring up the balance sheet, what do? They make the next mistake, which was, let's take that money and spend it on buybacks. And now companies like this are really just not prepared, and it's amazing how quickly they can go away.
Yeah, I have Dave Kranzler, who's another hedge fund manager, his article up from 2 days ago, and he says more than 3,500 stores are scheduled to be shuttered in the next few months. J.C. Penney, Macy's, Sears, Kmart, Crocs, BCBC, never heard of that one. Bebe, I guess that was a teenage or college girl one. Abercrombie and Fitch and Guess are some of the marquee retail names that will be closing down mall and strip mall stores, and the Limited is going out of business and closing down all 250 of its stores.
Yes, and this is what's interesting too. Is we try to look at we're spending a lot more time looking at these disruptive trends and these big waves. So I think in the past we were probably spending too much time on the cyclical. That the next bear market is coming. Well, it's more than that you have to pay attention to. You really have to pay attention to these long waves, and that it really leads you, I think, in terms of the research effort, it leads you to idea generation on both the long and the short side. So the longs, and this is also, you're looking at not only these big long waves, but the disruptive waves, but deflation. I mean, deflation is an unmitigated good, and it leads to opportunity. Companies like Amazon, they saw the deflation. We've had a 99% drop in bandwidth since 2000, or over the last 20 years. And this has created all kinds of opportunities. So on the long side, you're really looking for companies that are either riding that wave or they're driving that deflation down. But it also leads to ideas on the short side. And if you look at Amazon, of course, it was a great long, but it was also the gift that kept on giving on the short side. Because, I mean, how you just rattled off a bunch of names. I mean, how many companies have been destroyed by Amazon and the e-commerce model, and I think we're just getting warmed up, Jason.
Yeah, I mean, what I've heard is that Instagram, which is where you can post pictures, what online retailers are doing is they're posting pictures on their company Instagram of all their items. So basically, unless you actually want to go try on something at the store, you can look at all the items online on Instagram, and they even have the 3D software now with virtual reality where you can look around. And people at the store, what they would do, and Best Buy to an extent is having to deal with this too. And this is why I think Best Buy in the long term, their business model is in trouble too. Is that people will go to the store, maybe they'll try out some of the electronics, or in the case of retail, they'll try on some clothes, right? They'll write down or store it in their phone the name of the item that they wanted to buy, and then they'll go online and price it and get a better price. So, So they were being used as like a showroom area, and then price matching. So they were getting killed that way too. And price matching, which is what you're seeing Best Buy do now, just to keep their doors open, that destroys their margins if they're price matching Amazon.
Right. Yeah, and you just wonder where this goes next, right? You look at groceries. I think the online segment of the grocery market is something like 2%. So it just seems like this juggernaut is going to keep on going on, and it creates opportunity. I think I'm very much. This is why we need a bear market, because when the tide goes out, you really find out who's been swimming without a bathing suit, and it will identify the next big winners. I think this is going to be very interesting, and I think that companies like Amazon, they're starting to think about, not just starting, I mean, they've been thinking about this for a long time, artificial intelligence and what role that will play. And I can imagine a world where you have sensor technology and people will you'll have a system that will essentially know that, hey, you're out of toilet paper, you're just about out of soap, and it just automatically gets ordered. So there's just going to be a lot. It'll be so much more efficient for people, and that leads to another interesting area, which is the mall REITs. I mean, they've certainly gotten some attention today, but I think a couple of things that are interesting about the mall REITs and REITs in general, first of all, they pay out something like 90% of their net income has to be paid out in dividends. So the problem with that is that that's in order to avoid double taxation. The problem with that is that there is no rainy day fund.
Yep.
And the other factor that's been going on is this reach for yield. So the fact that interest rates have been driven down so much, and the money has just sort of indiscriminately gone into dividend yielding stocks and high yield bonds and that sort of thing. It's flowed into areas like this where the money normally shouldn't be flowing, and I think that has created opportunities on the short side.
And pension funds are huge investors in those REITs. Actually, around here in the Northern Virginia area, right outside of DC, I actually see signs that saying pension funds own this strip mall, or it's a real estate investment trust and pension funds own it. So, and we know they're buying publicly traded real estate investment trusts or REITs because they're reaching for yield, like you said. Now, in your presentation, you talked about the near extinction of bear funds. We've had, I think, an artificially driven bull market since 2009, since Ben Bernanke's Federal Reserve and then Janet Yellen's Federal Reserve. They didn't do the right thing and start raising actually, they shouldn't be. No one should have control of interest rates, but the interest rates should have been higher. They should not have been near zero, or academics talking about negative. Talk about some of the consequences then of the low interest rate policy, and just talk about some of the consequences of low interest rate policy.
Okay, well, it certainly has. Again, it's the marshmallow, it's the temptation, and it's kept a lot of companies in business, a lot of zombie companies in business that shouldn't have been there. It has, I think, enabled the government to borrow a tremendous amount of money, and so we've had this incredible debt buildup over the last 8 years or so. We've had globally, I believe it's been about $60 trillion. And I think this is interesting too. When we look at the last three bubbles, you always see these debt buildups going on. And the tech bubble, the big debt buildup was telecom, bank debt going to telecoms. It was about $1 trillion in new debt. In the credit bubble, it was mortgage debt, went up about $5 trillion. This bubble, you've got it's mainly corporate debt, as you mentioned, with financing things like stock buybacks and also acquisitions, definitely financial engineering. But it's also sovereign debt. So you've had an increase in debt in this country about $10 trillion, in China about $20 trillion, and overall about a $60 trillion increase. But it's also, and again, every bubble is different. So this time you see at the consumer level, even though mortgage debt has gone down a little bit, you're seeing credit card debt go up. You're seeing definitely auto loans. That has been, I believe, auto loan debt has gone up about 60% or so, and it's now at a little over 9% of household debt, which is the highest it's been in 14 years. But this is all enabled by low interest rates, and the terms, you're seeing a lot of the same types of things that we saw with the mortgage bubble, where you have very aggressive terms, very aggressive leasing terms, and so this is what we're looking for in terms of excesses and actually areas that we can short.
I think there's a lot of financial landmines out there, and we've covered a number of them during this interview. You named the subprime auto loan bubble. I think there's a pension fund underfunding crisis. China is an enormous landmine. Japan is a problem. We can go on and on naming them. The point I wanted to bring up, though, that I had forgotten a couple minutes ago when I asked you about the consequences of low interest rates, was about the Federal Reserve. Their willingness to allow asset prices to fall. While asset prices were going up after the reflation in 2009, it seemed that whenever there was, a potential correction in stock prices, the Federal Reserve would have Board of Governor members come out and speak, saying, we could do more QE. They would have open mouth committee, and or there would be currency swaps put into the market. I think, one of the reasons why these European banks haven't collapsed yet is because there was a lot of currency swaps, maybe trillions, that went to the European Central Bank, preventing Deutsche Bank from collapsing immediately and creating contagion risk. So do you think at this point now with President Trump, do you think the Janet Yellen Fed is more likely to allow a correction, a large correction or crash in asset prices under the 4 years we have with Trump?
Yeah, I don't think they will, but right now they're really in this mode of, and I think everybody is, not everybody, not the few bears that remain, but the bulls out there are kind of in the mode that, hey, we've got another wave of stimulus coming. Only this time it will be fiscal stimulus. There is this sense that hey, everything is okay. We can raise interest rates. I think they will continue to do that maybe a couple more times this year. And so I don't think any of them are really suspecting that there will be any kind of a downturn in the stock market. So we probably have a period where we don't have to worry about that. But yeah, at some point they will come in. The stock market will be down, and I'm not sure what it'll take. Will it be a 5% correction, a 10% correction? I can't imagine that they'll wait until a 20% correction, but they'll get the playbook out. And if we go back to 2007, 2008, that's exactly what they did. In fact, the Fed started cutting. Help me out here, Jason. But it was in 2007. Did they start cutting rates in was it October?
I don't remember exactly then. I actually wasn't paying a lot of attention to financial markets until 2008 and 9. So that's when I really started reading a bunch of books. It was during the height of the crisis I started to learn a lot. I know Greenspan was lowering a lot of rates while he was still there, and then he maybe raised a little bit at the end before he left, but he knew he had made a disaster because of those years prior to the housing bubble, how he had lowered rates so much.
Right. Well, rates definitely were just clicking up for a period of about, I believe, a couple of years, and then I think it was October of 2007 they finally started to lower rates. So you think about that. Going back to that bubble, of course, you had the housing. First of all, the home building stocks, they peaked in July of 2005. The first quarter of 2006, home prices started to go down. Then in February, March of 2007, you had the subprime bubble crack and burst. And then you had in the middle of 2007, and of course, at this point, the authorities are all saying, hey, subprime is contained. It's just a small corner of the market. Don't worry about it. And then Bear Stearns with a couple of their hedge funds, they blew up in the middle of 2007. And then Kramer, through his rant that, hey, Rome is burning and where are my boys at the Fed? We need them. They're nuts. They're nuts. He's throwing a tantrum. And then shortly after that, they started to lower rates. I believe that was in October of 2007. But the point is that they were lowering rates, and first of all, the cracks had already appeared. They were already very well developed in terms of housing and in terms of the credit bubble. But the stock market, despite all of the efforts to prop things up, it didn't prevent the meltdown of 2008. So I think getting caught up in, oh, the Fed to the rescue and we can't fight this, I think that's a huge mistake.
Well, the Fed allowed Lehman to fail. I mean, because Lehman thought, even Dick Fold and other people thought that Lehman was going to get a bailout. So I think once Lehman failed, I think that was the final signal that totally cracked the stock market. It then went to full panic because then people started examining counterparty risks like crazy because they saw that Lehman was allowed to fail.
Yeah, well, it's everything seems to be obvious in hindsight, and we'll see how this plays out this time. But I just feel like there's an accident waiting to happen, and that really our job as investors, as money managers, is to look at the landscape out there and to sift through the companies in terms of, all right, hey, a storm is coming. Which companies are prepared? And if we go into a killer bear market, you could have very good companies that are prepared, that will survive, and they'll thrive in the next bull market, and those stocks can go down 50%, 60%. But you're going to have a whole host of companies that are unprepared, and they will go down 80 to 100%. So I think our job right now is not to worry so much about timing, not to worry so much about how this plays out, but to sift through and just find out where we need to be invested, where we need to be short, where we need to be long.
That's a great point. And that's what happened to the gold and silver mining companies. They were bringing on high-cost mines in 2011 and 12 as gold and silver prices were starting to crash, and then we had a 5-year bear market. So, they were bringing on expensive projects, and there was enormous write-downs. Companies had to sell assets for pennies on the dollar. Stock prices, some of them dropped 80% for producers, juniors. Some of them dropped 99% or went to zero, or they sold the assets for pennies. So, the industry is going to be more careful, more prudent going forward about bringing on new projects and risking the capital. I wanted to ask you, though, about your opinion if you think Janet Yellen is going to increase interest rates 2 or 3 more times in 2017.
Yes, I think she will. I think they're on that glide path right now, and that to deviate from that would be to admit that they're not in control of things.
That's interesting. That's a big change. But have you read Danielle DiMartino's book, Fed Up, yet?
I have not.
Okay, well, you're in Dallas now, right? She lives around there, too. She worked at the Dallas Federal Reserve Bank for 9 years, and I interviewed her about a month ago about her book, and she thinks now, based on reading speeches of Fed governors and her contacts inside the Fed, she thinks there will be 2 or 3 more interest rate increases, and she thinks the Federal Reserve basically now is a political weapon. They've weaponized the Fed, and that the Democrats, who are PhD Keynesian economists at the Federal Reserve, will want to are willing to let stock markets crash a lot. Maybe they'll protect the bond market because the U.S. government needs to borrow, but they're willing to let the stock market crash and then blame it on Trump and the Republicans, so the Democrats in 2018 congressional elections can win back more of Congress.
Well, I guess I hope you're right. It would be nice if they would just back away, but I will believe it when I see it, to be quite honest, because I think they are married to this idea that they have to be in control, that they have to keep intervening, and that they can prevent the bust from happening. And what they're doing is they're creating the bust. I mean, they're creating it has to happen, and there's nothing they can do about it. They can't repeal economic law, but that's not going to stop them from trying. So it's just a question of how much are they going to let this drop before they intervene, and they'll intervene and it won't matter. I think that's the way I'm looking at it. So I'm not trying to get too worked up over what their plans are, to tell you the truth.
Yeah, I agree. At some point, the Fed's going to lose control over this, or people are going to lose faith in the credibility of all these different central banks. I'm not sure why they haven't lost credibility already. People like you and me and a lot of people listen to the show, they don't have any trust or credibility in Federal Reserve and other central bankers. But people on Wall Street and a lot of other talking heads in the mainstream media, they trust these guys. Like they know what they're doing, rather than, us being in a really dangerous live science experiment.
Well, what do they say? Trust takes a long time to build, but it can evaporate overnight. I think this is all going to end in tears.
Well, Kevin, I think the Democrat. I agree. There's going to be more pain coming, and the central bankers may be able to delay things a little bit, but in the real economy, I see worse stagflation. But if they do allow things to crash, and it would be a plan so the Democrats could regain more political power and then get back to crazy amounts of big government spending, more taxes, more regulation, which would, make things even worse for freedom-loving people and libertarians like me and small and medium-sized businesses. So they might be taking the view that, if we crash things now, we can blame it on Trump, we can limit him to one term, we can knock the Republicans out of Congress, and yeah, there'd be pain, but we can at least deflect the blame onto Trump and the Republicans. So and obviously, I think, the Fed deserves an enormous amount of the blame for causing all these booms and busts, so many of the different bubbles. I want to ask you now about the dollar shortage. Okay, so there's tons of hedge fund managers talking about a dollar shortage, but there's record amounts of dollar-denominated debt. So do you think then we have record amounts of debt, it doesn't seem to make sense that we would have a dollar shortage then? What's your take on this?
I don't think there's any shortage of dollars, and I think there's a tremendous amount of optimism. In fact, I think you can make a pretty good case that the expectation level for the Trump administration is high. And I look at it this way: that they want to come in with this aggressive fiscal stimulus, and they've got these plans. And if they are successful with those plans, then they'll fail. If they're not successful with their plans, they'll fail. So there's no way out of this. And I think the dollar is going down. I don't. But of course, the question is against what?
Yeah, I was gonna follow up with that. Yep.
They're headed in the same direction. So it's just a horse race. But I think at this point, I would say the dollar is definitely vulnerable. We're actually somewhat short the dollar right now.
Yeah, I was going to ask you against what. So, I don't see any currencies that are good. I expect a lot of volatility in exchange rates of a lot of currencies. There's a lot of central banks and treasury departments going in to currency markets and manipulating them to get favorable exchange rates. So,
yeah.
And then
we're short pounds. We're long pounds and we're long Swiss franc, but we're also obviously long gold. That's the biggest currency that we hold right now against the dollar.
Yeah, and as a libertarian and someone who follows Austrian school economics, when I hear about this dollar shortage with record amounts of debt, I see that people aren't taking personal responsibility for poor decision making. So no one put a gun to your head if you were a foreign politician or foreign corporation and told you had to borrow record amounts of debt in US dollars. So I think, a lot of the people who are borrowing all this record amounts of money and then saying there's a dollar shortage, they're being irresponsible. So they're kind of trying to deflect the blame away from themselves for borrowing all this money that now with the exchange rates moving and a stronger dollar in the dollar index that they can't pay back as easily. So that's what I see. So with record amounts of dollar-denominated debt available, I don't see a dollar shortage. I compare it to, on the analogy, Kevin, like the alcoholic, right, who has all this booze at his house. He drinks it all, and then he says, oh, there's an alcohol shortage. But, he can easily go buy more alcohol, or maybe he spent all of his money buying alcohol and then drank it all anyway. Now he can't go buy more alcohol. So I kind of view it like that.
Mm-hmm.
So I think, when the people, okay, yes, maybe there's not enough dollars to pay back the debt, but why did you borrow the debt? So that's kind of how I view things. So I think, framing things as a dollar shortage is not the right way. It's kind of like deflecting responsibility to, especially if you were the one who borrowed those dollars for either your government or your corporation or your company and you can't pay them back.
Right.
Well, I want to ask you now about which industries on the long side do you like? Is there anything, I know you're considered a bear, but I know you've added long positions now to your fund. You're a long short hedge fund with Bill Wagner over there. Are there any industries you actually think are relatively undervalued? And if we do have corrections in asset prices, would actually do pretty good?
Yeah, they're hard to find, but I can tell you, actually, one area that's kind of interesting, you look at the reaction since the election in the stock market, and there's been sort of all over the place, but you've had the S&P is up about 10% since the election, financial stocks are up about 20%, and but the gun-related stocks, so you've got, it was formerly Smith & Wesson, is now American Outdoor Brands, and Sturm and then also an ammo company, Vista Outdoors. These stocks are down about 20% since the election. So there's the assumption that that Trump is going to be not going to be pushing the gun control agenda, and that is going to sap gun sales. And I'm not sure that my base case with any new administration is the status quo. So I think the trends that have been driving gun sales for the last 8 years or so, my guess is that they will continue, and so that's one area. And I think the stocks look very reasonable right now. We are looking at defensive companies, the dollar stores. We actually have a little money invested in Dollar Tree. They acquired Family Dollar, and they're just you basically have a duopoly with what's the other, DG, Dollar General, and Walmart was getting into that business, and they've sort of left it to the dollar stores. So and of course they tend to get tarred with the same brush as all of retail. So I think they're somewhat insulated from what's going on, and they're going to be a little bit lower tier. So that's an area. Food. I mean, anything. We mentioned the poultry stocks before. And a lot of it's just kind of picking and choosing and looking for your spots in terms of pricing and that sort of thing. I wouldn't say that. I mean, I love Sanderson Farms. We own a little bit right now, but the stock has done well, and we'd like to buy it at a little bit lower price. But we're just poking around in terms of some of the defensive areas. And then also on the long side, we're always looking at these disruptors, companies that get out ahead of these deflationary waves. And you look at genomic sequencing. It cost back in 2000 $1 billion to sequence. The first genome was sequenced for $1 billion. Now it's under $1,000. So that's tremendous deflation. And a company like Illumina, we were able to actually buy it under 140. I think it's now over 170. So I wouldn't say it's exactly cheap, but that's a company. It just reminds me of Amazon.com, where it looks expensive, but they are just continuing. They're out in front of this wave. I think it's a long wave, and the way we're doing this is, of course, it's a hedge for us. So the fact that we might be, quote, overpaying a little bit for the stock right now, it's really hedging what we're doing on the short side, which is significant. And we just want to have a position, keep it on the radar, and then hopefully when we get the bear market, you'll see the tide go out, and we want to see the stock go down. So we're looking for, so that's really, in terms of the long side, it's defensive names, and it's these really long waves that we're looking at. But it's tough to find good opportunities today, I'll admit.
What about I agree with that. The valuations on a lot of stocks are very high, especially in U.S. markets, because I think there's been a lot of flight capital that's come in here from other countries into bond market, real estate market, and stock market here in the United States. And we've seen this with demand for gold in other countries like China and India, and Bitcoin prices too. So I think those are kind of indicators of flight capital. When I had you on the show last year, though, you talked how you liked potash stocks and long. Do you still like potash for resource plays or?
Yeah, we still do. We still own them. We have. Let's see. Foss Agro is a company we like, Russian company, and let's see. Jim Rogers is on the board, and he owns a stake in Foss Agro. Potash Corporation of Saskatchewan. I mean, it's kind of a mutual fund. You get a lot of exposure there, but basically the commodity space, that you've got different commodities, and there's certainly been a bear market in commodities. So, but these are essentially food commodities, and long term, people will eat. You've got growing population, especially in India. And so it's not too difficult to envision there being demand for fertilizer in India. And you've got a company like Agro. It's right up in Russia. They seem to be in a good position. So yes, we are still long the fertilizer companies.
Yeah, I see Trump's policies, whether they're protectionism and tariffs on China or VAT taxes. I've heard people mentioning that Trump may implement a VAT tax to fund some of his because the Congressional Budget Office is going to demand tax neutral policies. So he's going to have to come up with more tax revenue brought in to fund some of his expenditures that he wants to do. I see a lot more stagflation coming, Kevin, in the real economy, whether Trump's successful with some of his programs for infrastructure and defense, and that gets the velocity money in the real economy going and potentially some wage growth, or if Trump is not successful, that would accelerate the debt and people would start to worry about that, and that would be cost push inflation then, and that would be, stagflation as well. So I could see a number of different scenarios where there's stagflation, and I think that would benefit maybe food-related investments and also precious metals going forward.
Yes, I agree, Jason, and it's hard to predict how this all plays out, and that's why we try to kind of diversify our bets. And the nice thing is that the fertilizer stocks, they give you exposure to some different areas. Number one, they're defensive, but number two, if we do get a whiff of inflation, they could act as an inflation play. But I think it's an interesting time that, and I think this really kind of goes to what you can do with a hedge fund that's kind of unconstrained, that can go long and short, and to be short different asset classes. Is that today? Look at the bond market. I think and bonds have gone down. Treasuries have gone down in this country since the election for good reason. Any creditor sitting across the table from Donald Trump has got to be really, really nervous with his track record. But there's another thing is that we are actually short German boons. We're short Italian, French bonds, Japanese government bonds at very close to zero interest rates. And when a bond has a zero interest rate, it's trading. It can't go much lower. This is not like a normal short. Theoretically you have infinite risk, but with a bond that is at or near zero interest rate, you really don't have an infinite risk. I mean, unless rates could go to negative 100%, let's say. But we know that when rates get to negative 0.5% or negative 1%, there's a lot of alternatives for people other than paying the privilege to loan money. So there's a limit there. And so shorting bonds is also, it kind of checks a lot of different boxes under different scenarios. So let's say we were to have a recovery. I mean, we can't imagine that right now, but we get an economic recovery. Well, bonds rates are going to go up, bonds will go down. If you're right and we get a whiff of inflation, bonds go down. If we get if these governments that are just swimming in all this debt and we get a recession and tax receipts go down and then deficits go up, you'll get a whiff of default risk and bonds can go down. So we can think of a lot of scenarios where bonds can go lower, and it's hard to come up with a scenario where they go higher. The scenario that's certainly played out, and the reason why they've gone higher, is that the central banks have just been buying them.
Can retail investors short bonds, or is it something only hedge funds and institutions and investment banks can do?
It's only something we can do, and so you have to invest with us. No, it's actually not that difficult. I've actually looked at an ETF. I've been searching and searching for an ETF. I wish there were one out there, but to my knowledge, it doesn't exist. But it actually is not that difficult. There are futures, and they trade on the Eurex exchange, and so just open a futures account, and you can be in the bond short business, shorting German boons.
Is there a put option? Couldn't you just isn't TLT the Treasury ETF? Couldn't you just buy put options on that, or are there?
Oh, sure, sure. If you, I thought you were talking about the European, the Japanese government
Oh,
bonds, but if you
all right.
were to, yeah, shorting U.S. government bonds is actually quite easy. You're right. You could buy puts. There are bear funds on bonds. That's easy to do.
Oh, I was going to ask if there's ETFs like TLT for the foreign bonds that you mentioned that you were short.
There there are on the German Bund. There are bonds. I don't know how shortable those are, but there are long. There are no bear funds on German Bunds that I'm aware of, or the Italian or the French.
How much of your hedge fund is short right now? Is it more than 50% total compared to the longs?
300%.
300% compared to
Well,
the.
actually, we have two, Jason. We have two funds. So we are effectively net short about 300% in our aggressive fund, the Bearing Fund, and the other fund, the core fund, is about half of that. And we do that mainly through put options. So we
And
don't have necessarily that kind of exposure. We've been able to limit our exposure, and I think this is really important. So when you get an event like the Trump election, and we owned puts on Goldman Sachs, and the stock went up. It went from 170 to 240, I think. The nice thing about having puts when they're fairly close to the strike is that the bleeding stops, and it's a built-in risk control. So we do actually very little direct shorting.
yeah, that's a great point there about managing risk and using put options or call options to manage your risk. I actually put my dad into Goldman Sachs after the 2008 financial crisis when I saw that Warren Buffett had gotten that crony deal, and I knew they were going to get basically preferential treatment. So my dad had been long Goldman Sachs up until from 2009 crash, and Warren Buffett put his investment in up until about a month ago. So he sold.
Wow,
Yeah, so he wrote
great
it up a
timing.
lot. Huh?
Great timing.
Yeah, so he wrote that one up. How much cash do you have in your fund? Are you keeping a lot of dry powder? So if there is, a big stock market crash or crash in other asset prices, so you have dry powder to go and buy quality assets for cheap?
Well, our cash is really gold. That's gold and silver. So I wouldn't say we really have cash, but we have probably 40% in gold and silver.
Do you think retail investors should have a good amount of, in addition to gold, silver, and maybe physical gold and silver, maybe some Bitcoin as well? Do you think they should also have cash to prepare for an opportunity if there is a stock market crash like we've been discussing during this interview?
Yeah, I think they should have cash. I really don't have an opinion on Bitcoin. I don't. My business partner Bill is definitely more of an authority on that subject. I'm a little bit skeptical, but I will admit that I probably don't know enough to voice an opinion on that. But certainly, cash I think makes a lot of sense for the average person. I mean, we have cash. We own gold, and we also are long Swiss francs, and we're long British pounds. So I guess you could say that we've got cash in that respect.
Now, you ended your presentation with a quote from Ludwig von Mises. Do you think if von Mises were alive, do you think he would say that we're in the crack-up boom now, or that there's a lot of evidence that we've started it?
I really don't know. I mean, I don't know what he would think. I know that I don't think that is the next act in this play. I personally, I feel that the next act is really an economic minimum of a recession, where you just see a lot of businesses fail, and a lot of stocks that hopefully were short go to zero, or at least go down 80%. I think that's the next act in this play, and that they will try to paper this over, and it's just very difficult to predict how gold will do in that kind of environment. I think it'll do relatively well, but my guess is that this will kind of play out in waves, and that the first wave is the business and the economic drop, and then the second will be as people there could be a kind of a knee-jerk reaction into bonds as safe havens, and then investors will realize that, oh, wait a minute, this is not good if tax receipts are going down and we're swimming, the governments are swimming in all this debt, and they can't service the debt, that we've got a default problem, we've got a credit risk there, and then finally, if they come in with just the helicopters and start turning up the hoses and start spraying more money, printing more money, that the third and final act of this play could be a crack up boom where they actually destroy the currency. So, I mean, that's the way we think it'll play out, but that's why we don't have all of our eggs in one basket.
Well, Kevin, I really enjoyed your insights today, and I hope to have you back on again in the near future. I think, it's been very frustrating to watch how the Federal Reserve and Wall Street and, the politicians have basically gotten away with so much since the 2008 financial crisis. I feel that they've done nothing to stop the next crisis. They haven't allowed firms to fail that should have failed. They've created tons of new bubbles or tried to reflate old ones instead, telling people that, it's real economic growth when, all I see are asset prices going up, and I see the people on Main Street having their standard of living a lot worse. So if people do have a full-time job on Main Street, their bills are going up and their incomes are covering less, their purchasing power is being stolen. And I think, there's been a lot of stagflation and malinvestment, and, the banks have been fined since the 2008 crisis over $300 billion, and I don't think the banks have learned very much from all these fines. So I think, they're still making crazy derivatives bets, and it's setting up for another big crisis probably. If it doesn't happen this year, it'll probably happen in the next 2 or 3 years.
Yeah. Hey, Jason, can I give a plug?
Sure, for sure.
Okay. I've got an article coming out on LouRockwell.com tomorrow. It's called The Bear Crying Wolf.
Excellent. And I will put the link underneath the video after it's on YouTube so our listeners can check it out if this interview is out before your article is out.
Great. All right.
And if our listeners want to follow your work, Kevin, you're on Twitter. I know you're on Twitter, so our listeners can follow you there on Twitter. Is there anywhere else to contact you?
Twitter, and just Google me. We also have a website, bearingasset.com.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the wallstreetformainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.